Are we witnessing the end of recessions as we know them?
Indeed. Experts like George Gammon challenge conventional ideas about economic cycles.
In this video, we condense crucial insights from top analysts into easy-to-digest summaries.
Let's dive in, starting with George, who explores how current policies might change our recession landscape.
And stick around. We'll also hear from other experts on what these trends mean for your investments. Today, we're diving into the provocative claims made by George Gammon about the indefinite cancellation of recessions.
Gammon argues that current economic conditions and government interventions may alter traditional recession cycles.
George Gammon posits that recent government spending and policy changes could lead to a unique economic landscape where recessions are mitigated.
He notes that positive consumer sentiment and fiscal stimulus may create a less recession-prone environment. Gammon highlights that government interventions, like stimulus packages, may provide a temporary uplift to the economy.
Nonetheless, the sustainability of growth from these measures is a question.
While Gammon maintains optimism, he acknowledges that inflation could threaten economic progress.
His analysis emphasizes the need to balance growth stimulation with price management.
Gammon emphasizes that strong consumer sentiment can counteract recession signals.
He believes that ongoing consumer spending fosters a resilient economy.
What does Gammon predict regarding the possibility of sustained economic growth?
He suggests that if policies are implemented appropriately, traditional recessions could be avoided.
However, caution is warranted as inflationary pressures could affect these projections.
In conclusion, George Gammon's analysis encourages us to rethink conventional recession forecasts.
His perspective highlights the pivotal role of policymakers in navigating economic landscapes.
Ultimately, tailoring investment strategies based on government actions and market sentiment is vital.
Welcome. Today, we're unpacking insights shared by financial experts regarding recent admissions from banking institutions about economic stability.
Analysts highlight that these admissions reflect growing concerns around interest rates and their impact on consumer behavior.
Experts note that banking institutions are admitting vulnerabilities within the economic framework.
They argue that further rate hikes could diminish consumer confidence and spending, which is crucial for economic recovery. Analysts emphasize how rising interest rates can decrease consumer purchasing power.
Many businesses may begin to feel the impact as shoppers cut back on spending.
Discussions also include the potential for significant market corrections.
Experts suggest that as interest rates continue to rise, corrections may become necessary for market stabilization.
It seems that rising costs could lead households to rethink their budgets, right?
Exactly. Insights from banking analysts indicate consumers may feel the pressure to adjust.
Looking ahead, what do analysts predict for economic growth?
Many suggest slowing growth in key sectors as persistent interest rates affect markets.
In conclusion, experts advise consumers to anticipate tighter budgets amidst rising costs.
Investors are encouraged to adapt their strategies in response to the shifting economic environment.
Today, we're unpacking David Lin's analysis on the drop in mortgage rates and the effects it may have on the economy.
David posits that the fall in mortgage rates could stimulate buying activity, though economic uncertainty remains.
David Lin points out that declining mortgage rates often indicate serious economic issues rather than merely positive market conditions.
This connection to recession signals is vital, as historically low rates may reflect waning economic confidence. David notes the sharp fall in mortgage rates, implying this could welcome first-time buyers into the market.
However, the bigger question is, what are the long-term implications for the economy? What projections does David Lin have for the housing market?
David foresees that fears of ongoing recession could lead to persistent declines in home values, posing issues for current homeowners.
David Lin concludes that buyers need to be cautious in this economically shifting landscape.
It's essential to understand the economic backdrop to make informed real estate decisions.
Today, we're reviewing insights from Emily Brown regarding the challenges facing equity markets this year.
Emily emphasizes that rising Treasury yields may affect investor sentiment and risk assessment.
Emily Brown asserts that rising Treasury yields could pose a significant risk to equity markets.
David Lin adds that this volatility is causing shifts in how investors strategize moving forward.
What implications does Emily Brown see from rising Treasury yields?
According to Emily, higher yields could mean increased borrowing costs, pressuring equities and shifting risk perceptions.
David Lynn points out that current market volatility is influencing how investors assess risk.
Emily concurs, indicating that many are opting for more conservative investment approaches due to ongoing uncertainties.
What projections does Emily make about the market if these trends hold?
Emily predicts that sustained high yields could result in equity market corrections within the forthcoming quarters.
Emily Brown advises that investors maintain vigilance regarding movements in Treasury yields.
As discussed by both Emily and David, a diverse investment portfolio may be beneficial amidst rising volatility.
Today, we delve into insights on gold and stock market trends from our guest expert.
The expert points out important correlations between gold price fluctuations and stock market behavior, crucial for investors.
The expert proposes that gold serves as a hedge against inflation that can significantly affect stock market performance.
This relationship is especially important given the recent volatility in stock markets. The expert asserts that heightened market volatility requires a re-examination of investment tactics.
As buying and selling pressures mount, diversification becomes critical to manage risks.
The expert reiterates gold's status as a safe haven asset amid economic uncertainty.
This stability is vital during unpredictable stock market shifts. Looking ahead, the expert forecasts potential increases in gold prices if the economic environment worsens.
Simultaneously, stock markets may experience corrections due to persistent inflation concerns. The expert predicts that gold is likely to trend upwards as we approach 2024.
In contrast, stock market volatility is expected to continue due to macroeconomic factors. In conclusion, the expert emphasizes that staying informed about market indicators is critical.
Diversification is fundamental to navigating potential upheavals in the markets.
Today, we're discussing the latest insights from Sam Burns, who has shifted from previously identifying bullish trends to cautioning about the market's future.
Burns has raised important flags regarding economic stresses that could affect market stability.
Sam Burns believes the current market conditions are ripe for a correction.
David Lynn supports this view, indicating that inflated asset prices present significant risks.
Sam Burns mentions that rising interest rates could negatively impact investor confidence, leading to increased volatility.
Additionally, high inflation rates are squeezing consumer spending, which could create greater market challenges. To navigate uncertain times, Sam Burns recommends that investors consider cautious asset allocation.
He stresses the importance of diversification to protect against potential market downturns. What is Sam Burns' prediction for the market over the coming year?
Burns predicts a potential correction of 10 to 15%, citing ongoing economic pressures.
In conclusion, Burns recommends that investors closely monitor key economic indicators.
Furthermore, adopting protective strategies is vital for navigating the uncertain market landscape.
Wow, what an incredible discussion we've had. The insights from our experts are just mind-blowing.
Absolutely. From Sam Burns' concerns about potential market downturns to Emily Brown's analysis of Treasury yields, we've covered a lot.
And it's fascinating how everyone agrees on the importance of monitoring market volatility.
That's right. But there are some sharp differences too, particularly regarding the likelihood of avoiding recessions. George Gammon has a very optimistic view.
It makes for interesting debate, that's for sure. Plus, the conversation around the dynamics of gold versus stocks keeps evolving.
Definitely. The nuanced perspectives from our guests give us so much to think about as we navigate this changing landscape.
If you enjoyed these insights, don't forget to hit that like button and subscribe.
And sharing our video helps us reach even more people who value expert analysis.
Join us for the next episode, where we'll dive deeper into the implications of current economic trends. You won't want to miss it.